Have you noticed that when the market has an up day, many stocks are up, and then on down days, many stocks in the market are down? The reason for this is many stocks tend to move in the same general direction. But as we look outside the US stock market, other financial instruments tend to be a bit less correlated. I'm Scott Connor, a 30-year veteran trader, and today you'll learn about asset allocation right here on Virtual Trade. Welcome to Virtual Trade. In this episode, we'll look at why it can be important to diversify into asset classes outside of stocks that behave differently in varying market conditions. We'll uncover what some of these asset classes are all about, and finally, new trader Jenny Horne and I will continue the process of portfolio management. While diversifying your portfolio can make you less dependent on the performance of any single asset class, it may also dilute the performance of any individual asset if that asset does unusually well or unusually poorly. Effective diversification involves combining assets that behave differently when held during changing economic or market conditions. This may help your portfolio weather unusual risks, but it will not insulate your portfolio from major downswings. Deciding which asset classes, stocks, bonds, commodities, to use in diversifying and how much to allot to each is similar to selecting kites for kite surfing. There isn't a one-size-fits-all conditions kite. Kites are made for different wind speeds. If you have just one kite, you could only go out on days when wind speed matches that kite's specs, like an all-equities portfolio, when equities are falling and bonds are doing well. On the other hand, one could buy 3 kites to fit a broad range of wind speeds. This would enable the person to capitalize on whatever wind is offered that day, like stocks, bonds, real estate performance, which varies over time. Now, let's look at an example of how a couple different asset classes can affect an investment portfolio.
This example illustrates the annual returns of 3 different portfolios over a 10-year time period. The purple line, stocks, represents a 100% investment in large company stocks. The red line, bonds, represents a 100% investment in long-term government bonds. When the stock and bond asset classes were combined into an equally weighted portfolio, represented by the green line, the portfolio experienced less volatility than stocks alone and still maintained an attractive return. Notice that stock returns were up when bond returns were down, and vice versa. These offsetting movements assisted in reducing portfolio volatility and demonstrate how stocks and bonds might often be opposing. Remember though, diversification does not eliminate the risk of losses. As you can see from this chart, an investor with an equally weighted portfolio would have had limited losses in years 1, 2, and 8. Holding mutual funds or other portfolio-based products can possibly increase the diversity of your portfolio because these funds invest in many stocks and even a mix of different types of stocks. This may help reduce the risk of just holding a few stocks.
So to recap, portfolios with both stock and bonds are more likely to mitigate negative volatility exposure. Though diversification into different asset classes helps spread out risk, it doesn't eliminate the risk of loss. Mutual funds are one way that can add diversification to your portfolio. Now, let's examine how and where diversification can function.
Diversification can work in both bull and bear markets. This bull market graph illustrates the hypothetical growth of $1,000 in stocks, bonds, and a 50% stock, 50% bond diversified portfolio from October 2002 to October 2007. Stocks provided increased growth in bull markets. It is important to note, however, that this greater wealth was achieved with considerable volatility in stocks compared to the diversified portfolio. The significance of holding a diversified portfolio is most apparent when one or more asset classes are out of favor. The bear market graph on the right illustrates the hypothetical growth, or lack thereof, of $1,000 in stocks, bonds, and a diversified portfolio between November 2007 and February 2009. Notice that by diversifying among the 2 asset classes, the diversified portfolio experienced less severe monthly fluctuations than stocks or bonds alone. While bond prices tend to fluctuate less than stock prices, they are still subject to price movement. By investing in a mix of asset classes such as stocks, bonds, and Treasury bills, it may help protect a portfolio from major downswings in a single asset class.
As we wrap up, it's important to remember that effective diversification means choosing assets that behave differently in varying market conditions. Diversifying between different asset classes can reduce portfolio volatility. And diversification may reduce the degree of losses, but it doesn't eliminate the risk of experiencing investment losses. Welcome back. It's time for Tools of the Trade, where each day we look at various tools within TD Ameritrade, Thinkorswim, and Mobile Trader. In this segment, we'll be using the TD Ameritrade website to look at major asset classes and what they comprise. What we want to do today is get a better idea of the major asset classes that can be used for asset allocation. Now, up to this point, we built Jenny's watch list and, of course, then executed trades to build her first portfolio. And that portfolio was mainly focused on two of the asset classes, U.S. equities and international equities. What we'll be doing focusing today is what are some of those other asset classes and how might those play into Jenny's portfolio, for example. So what we'll do then is, by kicking things off, we'll jump right into the TD Ameritrade website where we'll log in with our username and password, the same username and password we'd use on the Thinkorswim platform, and follow along with me. I'm right now on the My Account page, and what we're going to do is move over to Research and Ideas, and then drop right down to Markets, and I'll go ahead and click on Markets. Now that'll take us right into this sector where we'll be able to see, first of all, as you can see here, you get a major overview of the market. This is a great place to even kick days off, trading days, to kind of get an idea of what the markets are doing in general. But as you can see down below, follow my mouse, now you can see the major asset classes. And like I mentioned, you can see the first one here is U.S. equities, of course, and global equities. Now again, we've already added some of those to Jenny's portfolio. What we're going to do is focus on some of the other three major asset classes: commodities, currencies, and fixed income. So I think what we'll do is we'll start off with commodities and jump into there. Now, before we get into this, you might be thinking, well, wait a minute, Scott, there's one other asset class, real estate. And you hear that come up quite a bit. And as a matter of fact, that's not on the list of major markets, but it's often considered a separate asset class and a separate sector of the equities market. Now, we did look at the S&P 500 sectors earlier on the Thinkorswim platform. We did see real estate on there. But again, oftentimes that is considered a separate asset class. We'll talk a little bit more about those as we go on. Well, let's start with the first one, like I said, commodities. I'll go ahead and click on that, and that will take us to the commodities asset class. Let's take a quick look at what pops up here for us. First of all, you'll see under the index, you'll see platinum, gold, silver, gasoline, copper, heating oil. As you can see, there's a lot of different things within the commodity space that could be invested in to round out a particular portfolio. If our focus has been so far on stocks, again, that's ownership in individual companies, but what about exposure to things like commodities? And that's why we're going to focus here to start off first. One of the things that you can do is break down even further within the commodities asset class. Take a look at right here where it says leading commodities. I'm going to go ahead and click on the first one. That's energy. So you can see within energy commodities, you've got heating oil, light sweet crude, natural gas, RBOB, which is the gasoline distillate itself, actually what we pump to put into the cars. You can see that the different prices of those and how those change. And here's what's interesting about this. If you go to the right side here, take a look at this 52-week range. What this does is it gives us a quick snapshot to see how each of these different commodities, how they are compared to their 52-week high and low. So you can see for the case, so let's just take the top one, which is heating oil. You can see that's sort of at the upper end of its range, whereas natural gas is somewhere in the middle or maybe just slightly lower on where it's trading. Let's keep going through the commodities in this asset class and jump into metals. You can see gold, copper, platinum, silver, and you can see this group in general at this particular time is sort of at the lower end of its 52-week range. And let's not forget one of the other major commodity classes, agriculture. This is cattle, corn, soybeans, sugar, wheat, things like that. Take a look at corns and soybean. Those are actually at the very low end of their range, and the other ones are maybe sort of the mid to low. Again, there can be many reasons that these things move around. Geopolitical is sometimes often one of the reasons we're seeing at this particular time some of the lower commodity prices in terms of agriculture. All right, well, let's keep going. What else do we have that we might go ahead and consider in a portfolio, let's jump to currencies. And currencies you can see underneath here, euro, which is the currency that's traded obviously in Europe. You have the pound from the UK, the yen, the Canadian dollar, et cetera, et cetera. Now, why might we look at something like this as a particular investment or part of a portfolio? Again, commodities move up and down. It's one of the deepest and most liquid markets that's traded out there. And of course, we can have exposure to the different currencies. Now, when you're looking at currencies, keep in mind, well, when we look at something like the euro, we're looking at the euro compared to what? Compared to the US dollar. Or if we look at the Japanese yen, we're saying how does it act compared to the US dollar? So oftentimes you're looking at currencies, their pairs, and how they are doing against the US dollar. Oftentimes we can look at things called the dollar index, which is how the US dollar is doing against a whole basket of other international currencies. But this is another asset class that we can keep an eye on. Now, let's do this. Let's go one more to the right and jump into fixed income. Now, first of all, what is fixed income? Well, when you hear the term bonds, that's kind of what we're talking about here in fixed income. How would someone invest in the fixed income asset class? Well, typically through bonds. That can also be in funds, mutual funds, exchange-traded funds, and we'll talk a minute about those coming up. But that's what we're talking about when we're talking about bonds. Now, obviously bonds are very closely related to the interest rates. So knowing what interest rates are doing in the US and different companies obviously would always play into this particular sector or asset class. As you can see right now, what I'm looking at right now is Treasury yields. And this is an interesting little chart right here because as you can see, if you follow my mouse, you can see 3-year bonds all the way out to 5 years, 10 years, and 30 years. Now, this is important because if you look at the blue line at the very bottom here, you can see it's got a fairly steep curve moving higher. In other words, the short-term interest rates, or these bonds that are 3 to 6 to 2 years, are down at this level, whereas a bond that's 30 years is up above the 3% level. And that's the typical curve what we have. And you might hear this, it's referred to as the yield curve. But look at more recently what the yield curve is. If you look at the dark green line up here at the top, that's the more recent look at the different rates between the short term and the long term. And you can see that's much flatter. So there's a lot of talk going on in the current marketplace about the yield curve. The reason being is that historically, when we've gotten to points where we get to what we call a flat yield curve, like you can see here, the dark green bar, where the short-term rates and the long-term rates are very similar, that has been oftentimes a precursor to the market actually moving into sort of a downward type cycle. So again, there's no guarantees that's going to happen, of course, but again, some people use this as sort of an indicator as to what the market may potentially be doing. So there you get an idea of some of the other asset classes outside of stocks. Now let's talk to you a little bit about when we're looking, for example, at fixed income. If you move down below, we've seen the rates on the chart here, to look at the actual products, like the 5-year Treasury note, the 10-year, and the 30-year, these are often traded as futures themselves. And of course, there are options traded on these futures as well. But the way many people can go ahead, like I said, and add something like this to a portfolio can be done through the futures market, the futures themselves, the options on the futures, and of course you can look at funds based on those. And don't forget, for more information on these tools and other great education, visit the Education Center on tdameritrade.com. Welcome back to Virtual Trade. I'm joined once again by new trader Jenny Horne. Jenny, welcome back.
It's good to be back, Scott.
Well, Jenny, what we're going to do now is we're going to create a watch list that focuses on something other than stocks. We're going to be looking at different asset classes.
Great. Well, I am familiar with building watch lists thanks to you, so I think this should be a little bit easier, hopefully.
Right. So the reason we're looking at different asset classes is, we have our established portfolio of stocks, and we've talked about how we sort of top-down analysis to find those stocks. But we continue to always focus on diversification when you're managing a portfolio.
Right.
So,
that is a word we've brought up before.
Exactly, right? Spreading your risk out over different investments, if you will.
Right.
And that helps us sort of navigate volatility in the marketplace. So what we're by doing is by adding this watch list, though we haven't added any of these to our portfolio yet, let's create a watch list that's going to help us sort of decide what those different asset classes are. Sound good?
Sounds good.
All right, well, let's get started. First of all, we're going to need to create a watch list, so let's go into the Market Watch tab. Jenny, I'll go ahead and let you navigate here.
Okay.
We happen to have the Dow Jones Industrial Average in here, but we want to create our own watch list. So if we move over to the right side and click on the 3 bars, and then drop right down to create watch list. There we go. So let's create this watch list. You know what we'll do? We'll call this asset classes. And you can put the word watch list on or just leave it as is. That's probably okay.
I'll add watch list.
Okay, fine.
Makes it consistent with the other one.
Perfect. Now we'll save that. And as you can see, asset classes watch list is now in there. So here's what we're going to do. We need to go into a list where we can find a lot of these sort of alternative asset classes. Now, a lot of these are going to be what falls under the futures category, and you'll see that. So I think the easiest way is just let's open up a futures watch list.
Okay.
So right there where it says asset classes, just click on that, and then we'll go into the futures. So drop down to public, find futures in there. Actually, I have to go up one, I believe. Oh. There we go. Yeah, drop down to futures and click on that. Now you can see there's quite a few different futures in here in these asset classes. Now we're going to have to decide which ones we want to actually look at. And using futures to trade, or to actually, we're not going to be trading these, right? But we're going to use these to track these different assets. So that's why we're in the public watch list to do just that. Now, how do we add some of these futures to our watch list? And let's just go through them one by one, and maybe we'll explain, what kind of asset class is and why we would want to watch it.
Right, because I have a few questions here. Well, yeah,
I bet you do.
Yeah.
Okay, well, let's get started. One of the first asset classes that we're going to watch and get into this list is /ES, and that is actually the future based on the S&P 500.
Okay.
And one of the reasons we watch the futures, Jenny, is that they are open virtually 24 hours a day. Mm-hmm. So when the U.S. market closes and the New York Stock Exchange is no longer trading, the futures will continue to trade overnight.
Wow, I didn't know that.
Right, and now if we look at a future based on the S&P 500, we can kind of see how the U.S. market is doing even when the stock exchange is closed.
Great, yeah, that's really useful.
So let's get that one in our list, and it's /ES, and you can see it says E-mini S&P 500 Index Future. Now, if you right-click on that, just right-click, and then add to watch list, and then drop down to our asset classes, just left-click there, and it will go right into our watch list.
Great, that was really easy.
All right, well, let's add another one. Let's keep going. Now, another thing that an asset class outside of stocks would be oil, and the commodity oil. Now, a lot of these things we're going to be looking at now are commodities. These are alternatives to stocks and bonds. So now we need to find oil. Now, the symbol for that one is /CL.
Now, is there an easier way to search than me just scrolling through this list?
Well, there certainly could be. Well, you can see it's on the right side, it is alphabetized.
CL, okay.
Right, so that's light sweet. So if you remember, it's light sweet crude oil. That will give you the word. Now let's right click on that one and add that as well. Now, you might be wondering, why are we adding oil to my stock portfolio?
Kind of.
Exactly, and that's why we're looking at different asset classes, because oftentimes, Jenny, the market can be moving up. When I say that, the stock market. So a lot of stocks can be moving up and down together, while perhaps oil is going down in value. And vice versa, the market can be falling when oil prices are going higher, for example. So by spreading out that risk, and we have different volatilities and movements in the different assets we have, sometimes they can kind of balance each other out.
So you're saying if in my first watch list, if all of the stocks were down, if all of the stock market was having a bad day, if there's a chance that these might be doing all right then.
Exactly.
Okay.
Right, because they don't always follow the stock market. Oftentimes they'll actually move the opposite or sideways while the market's either moving up or down.
That's fascinating.
All right, so light sweet crude oil. Let's keep going on this. Sort of in that same commodity, let's look at natural gas. Natural gas, and that should be /NG if you find it under N. Is it in there under natural gas?
And so.
Well, actually, if we look under the description of natural gas. Let's see if that comes up. There it is, yeah. Natural gas just a little bit higher. Yeah, we're at one higher.
Oh, there we go.
There you go,
okay.
yeah. N for natural gas, perfect.
Thank you.
Now let's add that one to our watch list as well. Natural gas, of course, something that we all use. People use that to power their homes, to heat their homes, run appliances and all sorts of things like that.
Right, very useful to every day.
A commodity as well. Well, let's keep going on this. Let's look at a different commodity. Those were sort of energy-related commodities. Now, there's also different things we call like precious metals.
Okay.
Right, and they have another whole sort of life of their own outside of the way the stock market moves. So let's look at gold, GOLD, and just scroll down. We're in the F's. So let's see, scroll back down up to the, go up, I'm sorry. We want to go to the G's. E, F, no, that's the E's, keep going. E micro, E mini, keep going down, and then we'll find gold. There it is.
Futures, there we
Perfect. All right, so this is the gold future. Now, interestingly enough, precious metals, gold, silver, palladium, things like that, can also move inverse to the market. And again, those are commodities that have value that goes up and down, just like stocks do.
Now, why is that? Why do they move so differently than stocks do?
Well, that's not an easy answer. There's a lot of things that move gold. Some of it has to do with inflation. For some people that go into gold as a sort of a safe haven, so when the market's crashing and there's uncertainty in the market, a lot of times people will go to gold as sort of a safe haven.
So then why wouldn't everyone just invest in gold?
Well, not everyone does, but some people make it a part of their portfolio. And that's why we're going to monitor these and maybe eventually add some of these to our portfolio. Let's keep going. Well, let's talk a little about Treasury bonds and Treasury notes, because interest rates are important as well. So we'll go down to /ZN is the symbol here, and it would be under the Treasury notes. Maybe, there you go.
I saw that one already.
You found it.
Yes.
Perfect. So let's add that one. And then one last one, we'll look at currencies, another asset class. You always hear about the US dollar. Well, typically the dollar is measured against other currencies. So let's go to one called the euro, which is /6E, and we'll add that to our list so we can sort of have one major currency that we'll be able to watch and see how the US dollar is doing, for example, against the currency, the euro.
Tell me if I'm missing it.
Let's see, go down a little bit lower. It says euro. Yeah, keep going right there. Let's see, euro
6E,
futures.
there we go.
6E, exactly. Yeah, sometimes I just go into the description and look for the word and scroll down. That seems a little bit easier. All right, perfect. So now let's do this. Let's go back to where futures are and drop down to our personal watch list and open up our new asset classes, and there you go. So nicely on here, you'll have the description right next to that symbol, Jenny, so it'll be a little easier to watch.
Right, this is definitely much more manageable than that longer list.
Okay, so we've created our asset classes watch list. We'll keep an eye on these, and then we'll discuss a little bit more about how these could potentially fit into your portfolio as well.
Great.
All right. So that's pretty much it for today. We'll save this watch list, and don't forget, you can also open this watch list on the left side by clicking on the plus button, going to watch list here, and then of course going to personal. Let me do that real quick. And then asset watch class, and then we can look at your portfolio of stocks as well as our new asset.
Oh, great. So I could really always have my 2 watch lists open at any time.
And easily access them right on the left side.
Right, and see really how they're doing almost immediately.
So Jenny, how'd you feel about this exercise?
Well, I think this was really great, Scott, because a lot of times asset class can sound overwhelming to someone like me, and I think this is a much simpler way to think about it.
Right, and we'll come back to this asset class and add them potentially to our portfolio. Well, Jenny, that wraps up our session for today, and I certainly look forward to seeing you next time.
Thanks, Scott.
In this episode, we considered why it can be important to diversify into asset classes that behave differently in varying market conditions. Plus, Jenny and I continued to learn how the Thinkorswim platform can help us with the portfolio management process. I'm Scott Connor, and thanks for watching Virtual Trade.